Hi, in this video we are going to have a look at the credit risk transfer mechanisms. This is part of FRM Part 1, Foundations of Risk Management. Now, we'll first go through the learning objectives and then we can discuss some of the most important concepts in this section that you need to understand in order to get familiar with this particular topic. So in this section, we will discuss various credit derivatives that are used by organizations to transfer credit risk, and also some of the advantages and disadvantages of those credit derivatives. We'll also look at some of the traditional approaches firms have used in the past and even now to manage credit risk. We will discuss also how credit derivatives contributed to the 2007-2009 financial crisis and some of the changes that took place in the credit derivative market after the crisis. And finally, we will look at the securitization process and describe a special purpose vehicle. So first, let's look at some of the main credit derivatives that are used by most of the firms. So one of the most popular credit derivatives is a credit default swap. So let's look at how a credit default swap works. Now, let's assume that Bank B is lending 500 million US dollars to firm XYZ in a particular country. So let's assume, just for this example, that Bank B is based in US and firm XYZ is based in Greece. Now, when Bank B lends 500 million US dollars to firm XYZ, let's assume this is for 10 years, a 10-year loan. Now, of course, the risk is that XYZ might default during this period, and the biggest risk for Bank B is not to receive the notional 500 million end of 10 years. So that's a big risk. Now that's called a credit risk. So in order to reduce that credit risk or to transfer that credit risk, what Bank B could do is Bank B could enter into a credit default swap with Bank A. Now the way it works is Bank A would agree to pay Bank B in case XYZ defaults. Bank A would say, okay, if XYZ defaults, I will pay you $500 million or any of the default sum. Now, in return, Bank A would say, for example, will charge a premium. So for example, let's assume the premium is 2% on the notional. Notional is $500 million. $500 million. So that's equals $10 million. So the way it works is Bank B has to pay Bank A 10 million. This is just an example, $10 million every year. So this is an annual payment. So every year Bank B would pay Bank A $10 million. So you can think of a CDS just as an insurance policy. So that's the policy payment. So every year Bank B would pay Bank A $10 million. Every year this will happen. And let's assume that after 5 years company XYZ defaults. It's just a hypothetical example. Let's assume that after 5 years company XYZ defaults and Bank B was able to recover 300 million. Out of 500 million, Bank B was able to recover $300 million. So that means Bank B could not recover the whole principal. In other words, Bank B could not recover 200 million. Let's assume that Bank B only recovered 300 million. Now, what will happen is, in this case, since that Bank B has already entered into a credit default swap with Bank A would pay the difference. So Bank A would pay Bank B that 200 million that Bank B could not recover. So you can see by entering into a credit default swap, Bank B has protected itself from the credit risk of XYZ. Now, that's the whole purpose of a credit default swap. Credit default swap is used to transfer the credit risk. So in this case, Bank B has transferred the credit risk of XYZ to Bank A. Now, of course, you have to pay a premium, periodic premium. Now, in this case, it was 2%. It was 2% every year. So that has to be paid. So it's very similar to an insurance policy where the buyer of the CDS, so in this case, the buyer of the CDS is Bank B, pays the seller of the CDS a premium, and the seller would pay the buyer if one of the default events occurs that's already outlined in the CDS contract. So that's a credit default swap, which is one of the most popular credit derivatives in the market. So there's another credit derivative which is called collateralized debt obligations, or in shortened form we can call it CDOs. Now these are very popular in the market. So the way this works is, so assume you have a bank. Now the banks lend money. They lend money as loans, mortgages, credit cards, you could have student loans, etc. Now, of course, when banks lend money to various clients, corporate clients and retail clients, the risk is that some of the loans will be defaulted. So there's quite a lot of credit risk. Remember, credit risk is one of the largest risks a bank has to manage. So there's quite a lot of credit risk. And of course, these loans and these mortgages can have various periods. An average mortgage can be anything between 25 years to 40 years. So you can see that the credit risk can stay in your books for quite a long period. So what banks do is they package, so they take all these debts, they transfer those into a different entity, and then they sell these to investors as an investment product. So what do we mean by this is that, now let's assume that this bank has, for example, 100 million worth of loans, 50 million worth of mortgages, and 100 million worth of credit cards. So of course this could be distributed among 20 million customers, another 50 million retail clients, etc. So you can see the bank altogether has about 250 million exposure. So what the bank could do is, the bank could take all these 250 million worth of debt, package them in a way, and apply them into different tranches. So here you have 3 tranches: junior tranche, mezzanine tranche, and senior tranche. Now of course you will have different ratings, so that means high quality debt will be part of the senior tranche, most lowest quality debt will be part of the junior tranche. That's what you can see. This junior tranche has a lower credit rating, and then debt that's in between these two can be put into a mezzanine tranche, where you can see it has a AA credit rating. So these credit ratings are normally provided by a credit rating agency. And then you can see there's a particular interest attached to each of these tranches. You can see the junior tranche has the highest risk because it has the lowest credit rating. So if you purchase something from the junior tranche, a note from the junior tranche, the default risk is much high compared to a senior tranche, and that's the reason you're compensated with a higher return. So what this bank could do is, by transferring this 250 million worth of debt into the various tranches, and then the bank can sell these to various investors as a investment product. By doing this, the bank has effectively transferred the credit risk into those investors. So that's what these are called collateralized debt obligation. In other words, the investors' returns are dependent on these customers paying their loans. So you have customers, loan customers, mortgage customers, credit card customers. As far as all these customers repay their interest and their principals, these investors will be getting their return. If one of those clients defaults, it will first affect the junior tranche, and then if more clients default, it will affect the mezzanine tranche, and then finally it will affect the senior tranche. So you can see the debt is collateralized using these products, the loans, mortgages, credit cards, etc. Now some investors are attracted to these kind of products because they provide you a higher return compared to a traditional investment. So these are collateralized debt obligations, which are a very popular way of transferring credit risk. You can see by using collateralized debt obligations, a financial institution can transfer all their credit risk to investors. Now, of course, there are specific collateralized debt obligations. For example, there are mortgage-backed securities, which are called MBSs, or you can also call them residential mortgage-backed securities. So those mortgage-backed securities means you only include mortgages. So you take all the mortgages and you package them into different tranches and you sell it to investors. Then you have a similar product called collateralized loan obligations, CLOs, collateralized loan obligations. Now in this case, you would take various commercial sector loans and then package them into different tranches and sell them to investors. So you can see collateralized debt obligations is a popular way of transferring credit risk, and this whole process is called securitization. This whole process is called securitization, which we will touch again in as part of another topic in the same section. So let's look at some of the advantages and disadvantages of credit derivatives. So some of the obvious advantages are that credit derivative transactions do not affect the underlying positions. In other words, when a bank lends some money to a corporate client and wants to hedge the credit risk by entering into a credit default swap, the bank doesn't have to affect the underlying loan itself or change the underlying position. So that's one of the advantages of entering into a credit derivative. Also, credit derivatives can isolate credit risk without incurring funding costs. Now, for example, if you think about entering into a trade with the exchange, for example, there's quite a lot of funding cost that will incur in terms of margin payments. Now, using a credit derivative, you can isolate credit risk without actually incurring any funding costs. And also, client management issues are eliminated. Now, this becomes a issue. For example, assume that you have quite a lot of collateral with your counterparty. So let's assume that you're lending quite a lot to various clients and you're managing your credit risk by requesting collateral. Now, what this means is that every day you need to value your collateral, measure your collateral to make sure that your collateral is sufficient to reduce your credit risk. Now, by entering into credit derivatives, you don't have to do any of this. So your client management issues are eliminated. Now, of course, there are disadvantages as well, or you could even call it challenges when you're trading with credit derivatives. So one of the biggest ones is that each party should clearly understand what risks are transferred. So for example, what we mean by this is that if you're entering into a credit default swap to hedge some of the counterparty risk, both parties need to clearly understand what constitutes a default event and what are the payment terms if a default event happens. So that's what we are saying here. Each party should clearly understand what risks are transferred. Also, what specific events will result in a trigger event of a CDS should be understood clearly. Now, for example, is the trigger event change in credit rating, or is the trigger event is a delay in payment, or is the trigger event a change in one of the key balance sheet ratios, etc., should be clearly specified. Also, what are the obligations of each counterparty in a trigger event should be clearly understood. And finally, when is the contract enforceable? Of course, that sounds as common sense, but what we are saying is when firms enter into credit derivatives, all these details have to be clearly ironed out, and it has to be transparent, or else there could be issues when there's a default event occurs. Now, traditionally, there have been various approaches to mitigate credit risk. Now, some of these topics we will touch at a very high level in this module, because you will look at them in quite detail in some of the later modules in FRM part 1. So some of the traditional ways to mitigate credit risk is purchasing insurance from a third party in terms of a guarantee or an underwriter. For example, a retail bank who lends to retail clients loans, personal loans, can require a guarantee from another client or another customer. The same way, a bank which lends to corporate clients might require another firm to underwrite those loans. In other words, underwriting is a form of an insurance. So if the corporate client defaults on a loan, then the bank can exercise their rights, and the insurance provider will repay the default amount. Of course, netting of exposures is a popular way of mitigating credit risk. So netting of exposures simply means, for example, if firm A and firm B enters into a couple of transactions, and let's assume that firm A has to pay $1.5 million to firm B, and firm B has to pay $1 million to firm A. Now, by netting these two transactions, we can arrive at a position where A and B, and firm A has to only pay $0.5 million to firm B, because this $1 million has been netted. Now, the reason this is beneficial, so you can see now in this case, of course, firm B's exposure to firm A has been reduced to 0.5 million. Now, the reason this is important, now let's assume for some reason firm A goes bankrupt. Now, if firm A goes bankrupt, and let's assume that there's no netting agreement between A and B, then of course B is not going to get this 1.5 million. B won't get this 1.5 million because firm A has declared bankrupt. But still, firm B has to fulfill its obligation and pay this 1 million. So you can see that without netting, firm B has to still pay this 1 million, even though that firm B will not receive its 1.5 million from firm A. Now in here, since these two transactions have been netted, if firm A goes bankrupt, then firm B doesn't have to pay this 1 million, because these two transactions has now been netted under a netting agreement, and now if firm A defaults, of course firm A won't pay this 0.5 million. So in this case, the only credit risk for firm B is firm B will only lose 0.5 million. Now in this case, firm B will not receive 1.5 million, plus will have to pay this 1 million. So you can see netting helps to reduce credit risk. So also margining or marking to market also helps to reduce credit risk, and this is mainly observed in the exchange traded market. Collateral to be used to minimize credit risk. So you can also use collateral, can be used to minimize credit risk. The one thing you have to be careful when using collateral is that to avoid wrong way risk. Termination of contracts in case of specific events can also be used to mitigate credit risk, such as, for example, the specific events can be rating downgrades or change in balance sheet ratio. So this is where, for example, let's assume that individuals have lent to a particular corporate in terms of purchasing bonds. Now there could be some specific text in the agreement which says that if the corporate's rating is downgraded or if there's some change in balance sheets, then the contracts are terminated. So let's look at some of the issues with the securitization process, and also what do we mean by a securitization process. Now, when we discussed about the collateralized debt obligations, we already discussed how a securitization process works. Now remember, in a securitization process, what happens is a bank will have various assets such as personal loans, corporate loans, mortgages, credit card loans, student loans, etc. Rather than taking or bearing that credit risk, what a bank could do is to sell all these assets to a special purpose vehicle. So this is a separate legal entity. And what the SPV will do is the SPV will organize all these debt into different tranches or buckets. So the most risky ones will go into the junior tranche or junior bucket, which are, for example, equity instruments. And then the most safest ones will go to the senior tranche or senior bucket, and the ones which are in between will be in the mezzanine tranche. So what happens is that once these are bucketed and there will be a credit rating assigned to each one of them, they will be sold to investors. What happens is so this is a securitization process. Now what happens is that when investors purchase these notes, the investors would not know most of the time what's the underlying risk that they are exposed to. Now remember, the underlying risk relates to these loans. Now for example, here you can see, let's assume that this is one of the most bad debts. In other words, let's assume that this bank has lent $300 million to one of the corporates who's highly likely to go bankrupt very soon. But the way all this will be mixed and packaged here, each of these investors might not exactly know what they are investing on. Now, for example, if you know that you're buying something as a note which is linked to a very bad debt that's going to be defaulted soon, you're not going to invest any money on those notes. But the way they are packaged, the investors, most of the time, the investors won't know what exactly they are investing on. So this was one of the biggest issues during the financial crisis which occurred during 2007-2008 financial crisis. So that's what we are saying here. One of the biggest issues with the securitization process is moral hazard. In other words, investors don't have transparency on the credit worthiness of borrowers. In other words, the investors are not exactly sure on the quality of the underlying exposure. Remember, for each tranche, the rating agency will assign a credit rating. Now, when the rating agency assigns a credit rating, normally the rating agency will not go through the underlying exposures to determine the credit rating. So this is one of the risks of trusting the ratings of credit rating agencies. So one of the another issues with the securitization process, which happened during just before the 2007-2008 crisis. So during the pre-crisis period, many banks acquired securitized mortgage credit risk. So remember, the original purpose of the securitization process was to transfer credit risk completely out of the bank's balance sheet. But during the pre-crisis period, some banks were quite attracted to these notes, and what they did was, some of those banks set up something called structured investment vehicles. Mostly they were based in offshore to avoid any regulatory or tax implications. So what a bank did was, a bank set up a structured investment vehicle and purchased some of these asset-backed securities and sold those to investors as commercial papers. Now, what happens is, when they're sold as commercial papers. Before the crisis, some of these commercial paper notes were given a AAA rating. So for example, an investor might be thinking that this is a very safe investment, but you can see these investments are packaged from these asset-backed securities. So for example, if there are risky assets, this investment will not be a worthwhile investment, and this AAA credit rating itself is questionable. So that's what we are saying here. Investors didn't know the quality of underlying assets and the correlations between them. So for example, if all these loans were given to a couple of sectors that are highly correlated, then one default might also trigger the default of other loans, in which case these commercial papers might be almost worthless. So investors didn't know all these. Also, rating agents didn't properly consider the underlying risk when they were providing ratings. So these were some of the issues with the securitization process that led to the financial crisis. So let's look at the role of credit derivatives in the 2007-2009 financial crisis. Now, pre-crisis securitization process was one of the main contributors for the financial crisis, and as we discussed, one of the reasons was lack of transparency. In other words, the investors did not know what they were investing on. So this was one of the main reasons for the financial crisis. And also, CDSs and asset-backed securities continued after the crisis. So that means that CDSs and ABSs solely was not the reason for the financial crisis. In other words, even during the financial crisis, there were some CDSs and asset-backed securities were trading through the crisis and even after the crisis. So what we're trying to say is all CDSs and ABSs did not contribute towards the crisis. Asset-backed securities, mainly backed by credit cards, student loans and auto loans, etc., they are still continuing even after the crisis. Also, now the MBS market, so those are the mortgage-backed securities, they are expected to continue with more regulatory scrutiny. So of course the mortgage-backed securities led to the financial crisis. Was when we say led, it was one of the reasons. Now the mortgage-backed securities market is still active, but it's subject to more regulatory scrutiny. Also, the collateralized loan obligations. Now, after the crisis, the collateralized loan obligation market was not active till about 2011. But now it has come back and it has exceeded the pre-crisis volumes. In other words, there's quite a lot of collateralized loan obligation trading that's taking place at the moment. Now, there are some instruments that has been discontinued after the crisis, mainly due to its complexity, such as CDOs squared, single tranche CDOs, and complex asset-backed commercial papers. So these are some of the instruments that has been discontinued after the crisis due to their complexity. So remember, credit derivatives are quite useful to transfer risk, but one of the important things to understand is that credit derivatives were partly one of the reasons for the 2007-2009 financial crisis, and one of the main reasons was that it was not transparent, and also some banks which were supposed to transfer credit risk also acquired credit risk as part of the lucrative asset-backed securities market, and this led to the downfall of some of the banks. So if you have any questions, you can send us an email or put it in the comment section, and we will look at the details of the financial crisis in more detail in another section.